What's up, guys? Welcome back. Johnny here, and in today's video we're going to show you how to take your hard-earned money and make even more money. So if that sounds like something you want to do, smash that like button and subscribe so you don't miss any more of these awesome videos. So how do we do that? Well, everyone is talking about real estate, guys, and let me tell you, real estate is one of the hardest things to do. You may have money and you may have time, but oh my goodness, if you don't have the patience or the will to learn as you go, the will to fix problems or hire management teams to fix those problems, you will have problems all the time. Tenants are always breaking things. Stuff is constantly happening. Emergencies could happen where a furnace goes out or a water heater goes out, and all your monthly returns from their rent that you're receiving all goes out the window, and you may even have to owe money at the end of the day. Now, what's to say that those renters don't trash the place after being there for 3 to 6 months or a year and then leave? And leave it completely trashed? You are stuck footing the bill, repair, maintenance, cleanup, and ultimately getting it back in order to the, realization that you have to rent it out to another renter, and hope this doesn't happen again. Now, with all that said, you can still invest in real estate very easily without ever having to do any of that work or any headaches involved. And it's simple. You've already noticed we're on Robinhood and we're on the trending lists. I love looking at these lists. They have tons of different lists of sectors that you could invest in. You like pharmaceuticals? You like cannabis? Invest in that. Do you like energy or tech, media, and telecom? Maybe you like technology. You're a big technology buff on certain things. Now, with that said, let's go ahead and hit real estate. And real estate, there's over 240 real estate companies out there that are literally going to be doing the work for you. Now, Realty Income is one of those companies that own Walgreens and Rite Aids and definitely a ton of other commercial properties across the nation. They're having commercial rentals or commercial renters help them pay their mortgages down and ultimately pay their rents, which is just fantastic. They have a market cap of $41.18 billion, which is just insane. I do own a share of that on this small private or this small public account. I do have several other shares on my private accounts. Wendy's is just another one of those companies that's fantastic. If you're talking about real estate, why not make a little bit of money getting involved with Wendy's? They have hundreds, if not almost 1,000 locations in the nation, as well as other locations worldwide. Now, Wendy's is just one of those companies like McDonald's. They own the land when they set a Wendy's up. Then we have Gladstone Land. That's another great real estate company. They do involve themselves more with farmland and big commercial property land like that, but still one of those companies that you could not do without in your portfolio. Then you have public storage. Public storage, everyone knows what that is, right? Everyone has stuff they don't need or that they can't really move across country, so they stick it all in a U-Haul, go and take it to a public storage and pay anywhere from like $20 to $100 a month on storing their junk. Guys, that's what that is, junk. And this is right now is at $283 with a $49 billion market cap. This company, let's see, what are they paying out right now? Let's do some payouts. They have a 3.5% dividend yield right now and a P ratio of 11.97. That is fantastic, with a 30% growth over the past 5 years. That means you could have bought in at this company for less than $200, and at its peak you could have sold it for 100% profit at $408 back in April of 2022. But guys, don't let yourself get discouraged. When a company pulls back or a stock pulls back, all that does is gives you an opportunity to buy in at a lower price with usually a guarantee for it to go up. Now, definitely do your research. I am no stock guru, and I am just giving you my thoughts and opinions from my personal experience. But as you can see here, even if you missed out on the 88% gain and sold it for $400, you would still be set on a nice 31% gain if you sold it right now from 5 years ago. Now, this 1 year chart, it's down about 12%, but that's okay, right? Because that's a $41 discount on a company that could potentially go right back up to $355. Also could go back up to its $400 mark, right? Now, how do we know if a stock's going to go up or not? Now, technically we don't, but we can look at some past history, some fundamentals, and we can look at their bottom dollar and their, just seeing how the company's fundamentals are, how they're doing, what's happened in the last year and where they're going to be in the following year. Now, PE ratio is a fantastic way. I never like to invest in companies with a negative PE ratio. If it is negative, that means they are losing money on every share they own. And we don't want to lose money. We don't want them to lose money. But the ultimate thing is, we don't want to get trapped in the same cycle that they're in. This is our money we're talking about. So we want to make sure that we're putting our money in places that are profiting and doing well. Okay, another good thing to look at is the analyst ratings. You can consider me a non-credited analyst. I'm just, analyzing these stocks on my own and giving you my opinion. But there are over 14 ratings from analysts like Morningstar and Yahoo Finance and tons of other analysts out there who have gone to school for many, many years and do just this every day. You have people talking about why it would be a great bull market or it's going to go up, and you also have what the bears are saying for the reasoning why it's going to go down. And this is why I like Robinhood so much, because there is not something that differentiates the two sides on Webull or any of these other sites. They give you a lot of information, but they don't really differentiate it at all. Robinhood is one of those platforms that just is bar none right now, doing it better than most. I like the easeability of it. I like how simple it is to follow along. And if you guys want to start your investing journey, you can start for free today with $0 and get a free share or stock by simply signing up with the link below. You'll get a free share, I'll get a free share, and guys, I got a share up to $179 one time, and it was for Facebook, right? It was amazing. Some guy used my link, he got a awesome free share, and I got an awesome free share just for signing up. And then you can start investing as little as $5, right? Or you could take your free share and you can say, you know what, I didn't like this. I'm just going to sell it and get my money and deposit that money from that free share. Those are all easy things you can do. But Robinhood's one of those platforms that just makes it very simple. Now, as you can see, earnings have been slightly going up over time instead of down. That's what we want. And they have been beating their estimated earnings every single time. So they're not missing their estimated. They're actually going above and beyond. And this is just one way that you could look at fundamentals of a company or a property, right? Because we're talking about real estate, guys. We don't want you breaking your back and having to get a phone call from a renter at 4 a.m. because the water pipe busted, or get another phone call because they were moving a refrigerator in and they put a big hole in the wall. You know what I mean? You definitely don't want those phone calls, because those are phone calls that are not very cheap. Those are expensive phone calls. So as you can see, there are tons of companies, guys, for real estate. Let's look at another one here. Let's look at Stag Industrial. Now, Stag Industrial is one of those companies. It's up 35% in 5 years, which is great. It's a lower price, so you're not going to spend, $200 buying a share. You can get in comfortably for about $36. They've been founded since 2010, so fairly new company. Slightly higher dividend yield than the previous stock we looked at. It's at 4%. And their PE ratio is slightly higher as well. It's at 33. So I do like high PE ratios. Nothing ever in the negative. Anything above positive and about up to 50 is great. Anything above 50, I feel could be inflated, or it could be misinterpreted. Analysts right now, out of 10 analysts, are saying it's a 60% buy rating, which is fantastic. And their earnings has pretty much been at a constant about 56, 57 cents throughout. Now the dividends are paid out. Looks like right now, or back in 2020, it was about 12 cents a share. But again, they're paying about 4% in the dividend yield. And that's another good company. Now let's look at another one, AG&C Investments. Now this is a company that is on the other end. Okay, if you guys are still following along, type in AG&C in the comments so I know you got this far. But let's take a look at a company opposite of what we want to do. Okay, we don't want to invest in AG&C. Now why is this? AG&C has a dividend yield of 13.94%. So you're like, oh my God, 14% on my money. I'm going to put $1,000 in and I'm going to make $140 a year forever. Well, you'll make $140 in that year, but you might not make it forever. Now, here's a few key pointers as to why you should not invest in this company, at least in my opinion at this moment in time. Now, as you can see, it's down 47% in 5 years, which means it went from about $19 or $20 down to $10. If you put $1,000 in back 5 years ago, you would now only have about $500. Now your $500 would make you 14% of a dividend yield. So you're not making 14% off of 1,000 anymore, which would be 140. You're only making 14% off of 500, which would be roughly about $70. Now, not only did you lose $500 of your initial investment, or 50% of your initial investment, but you're also getting 50% less of the dividend yield. Why is this? Well, as you can see, their PE ratio is a negative 39. So that means for every share, they're losing 40. They're losing 40 of that, right? So it's a ratio. That's not good, guys. That's why I do not like to invest in a negative PE ratio, no matter how high the dividend yield is. This dividend yield could be 2% and very low and seem safe, but it's not safe because it has a negative PE ratio. Now, there could be a tremendous amount of different factors going into this. 50% of 12 analysts are saying to buy, but also are saying to hold. Now, there isn't a lot of news on this, and I have owned it in the past and received dividends from this company. It was about 12 cents a share. But I noticed the downtrend back in about January of 21 and just went ahead and sold my share. Let's see, January 2021 would have been right here. No, January. Right here. So I could have stayed going. I could have rode it out and got a little bit more money at the $16 mark and maybe got it back up to 18 before I sold. But again, we don't know what's going to happen. This long downtrend could have started back here in January, right? So I sold. I took my profits because they were realized profits. I didn't have any losses because I bought down here, and then it went all the way down tremendously. So guys, definitely pay attention. This could happen to any company, okay? It could be going up and be great for a very long time, and then it could just crash and burn. Look at this company, Apartment Income REIT. They're down only 4%. They had an IPO at $36 and now they're at $34. Look how high up it got. It got up to $54 or 52%. So at this point, a lot of investors would just throw money into it and say, I'm going to get even more money because it's going to go up even higher. Well, that's not the case because somebody sold a lot of their shares, or the company suffered losses due to numerous amount of factors, and it definitely just crashed and shot back down. Now it's saying it has a dividend yield of 5% at this moment and a PE ratio of 16. But just because of these two factors doesn't mean I would necessarily invest in this company. Now those two factors look great, but overall I would not say it's an upward trend. I would in fact say this is a downward trend, and it's down 23%. Now, if I see in say we wait another 3 months and we start to see indication that the market's going up, even in 1 month it goes up 5% and starts to rebound, I may consider buying, because we know that their fundamentals are starting to get better due to their price earnings ratio and their dividend yield. Until then, though, there's 10 analysts saying that it's a 60% hold rating and only a 40% buy weight rating. Now, why? If we do a little bit more research, we can see that the bulls are saying, while supply growth may be near a peak now, rising construction prices and higher lending standards will reduce construction starts and reduce supply growth in the future. Now, positive demographics and economic trends will fuel strong demand for apartment rentals, including the millennial generation, which probably won't have the necessary capital to purchase homes. Now, what are the bears saying on the other hand? The company no longer has development pipeline, so external growth opportunities will be limited, and those available are likely to produce lower yields. With relatively high total leverage, Aimco may divert more capital into paying off comparatively lower return debt or preferred equity. Now, the coronavirus pandemic may encourage more office employees to work from home, which could reduce demand for large apartment buildings for districts, transportation hubs, and basically just businesses in general. Although all this is being said on both sides, as a recent update of July 28th from Morningstar, the earnings per share is still an actual of 58 cents per share, which isn't necessarily bad. But guys, this is one way that you could invest in real estate without necessarily having a headache of what your renters are doing and how much they're destroying, or how much you're going to have to repair and maintenance when they do leave, or during the stay of their visit and stay at their property. Do your research, guys. EPR Properties looks fantastic. They have a 7% dividend yield and a 20% price earnings ratio, or a 20 price earnings ratio, but they're down 32% in 5 years. That's not a company that I would invest my money in, no matter how good their dividend and how good their PE ratio. So again, do your research, just like with real estate, but it has definitely a less headache factor and a more just like mental factor. You could buy some shares, it's not doing so good, it's down a percent point, you could sell, right? Okay, I lost 1% of my total yield, compared to, oh my gosh, I have to put in 20% of the value to fix the flooring of a house. So if you guys got this far, you enjoyed the video, smash the thumbs up and subscribe if you haven't already, and we'll see you guys in the next video.